Hey everyone, happy Thursday, October 31st. Happy Halloween. It's about 11:50 on the West Coast and it's time for another market updates. A busy week this week. We got inflation data, jobs data. We know those are the most important things that the Fed's paying attention to. So let's get right into it. First thing I wanted to cover is today we got September's PCE inflation data. This is the Fed's favorite form of inflation to take a look at. Headline came in as expected, down to 2.1% year over year, which is a good low number. That's getting closer to where we want to be. Core ticked up a little bit depending on who, last month it was 2.6 to 2.7. This month it's 2.7. So a slight increase right there, which the bond market obviously wouldn't like to see. So overall, not the worst numbers, but again, not something that was going to change the narrative, the direction where rates have been, going up over the last month or so. So a little disappointing to see that core number, especially coming a little bit higher. But overall, these are pretty good numbers. If we were, looking at it in a box and not having to deal with the narrative we have over the last month. Next thing, so this is jobs week. This is when we get all the big jobs reports. First one we got this week was JOLTS. This is job opening data. This is for September. That came in at 7.44 million. The expectation was about 7.95 million. So that was a good one to see for us. The job openings tends to be where you first just start to see the weakness in the labor market. Less job openings, less people are hiring, and so forth. So this number continues to drop. It is kind of it's never been the most important number that the markets look at. It's kind of gained some importance over the last couple of years, but it's also a little dicey. There's a lot of online job postings, so it's hard to say exactly where that number lies. But overall, that was a good number to see. And the next one we got was October. They already give us October numbers for ADP. That came in yesterday, and that came in a lot higher at 233. 233,000 jobs created. Expectation was 115,000, as you can see here. So a lot higher than expectations. That wasn't good to see. The September report was revised higher from 143 to 159. That was, again, strength in the job market is nothing we want to see right now. It looks like across the board, it showed strength, mainly large and medium-sized business, not many small businesses adding jobs. Manufacturing lost some jobs. This part down here, wages, is the only thing that really came in our favor and made it from being even worse. Job stayers dropped from 4.7 to 4.6% increase in wages. Job switchers from 6.7 to 6.2. So this is good for wage inflation. It tends to be the more we have, the more money we have, the more we spend. So anytime we see wages and wage inflation going up, that tends to increase normal inflation, like the PCE stuff we're first looking at. So again, that was a bad one. That was not a good job report. We were hoping to come in, lower, especially after that BLS jobs report last week or last month. But that was not good to see. The markets did not like that at all. Next thing we got, this came in our favor. The Q3 quarter three for the United States, their GDP. The first time they take a look at this, came in lower than expected. It was supposed to be 3% to 3.1%. It was in at 3% last quarter, came in at 2.8. So that was a positive. See, again, like we've talked about, anything job market strong, economy strong, Fed's not going to cut rates as often or at all. So that's why we kind of want to see weakness in GDP, in the jobs market. We want to see inflation coming down. These are pretty important things for those of us that want mortgage rates to come down. Next thing, initial jobless claims. This came in a lot lower too. 230,000 were expected, came in at 216,000. This continues to be a pretty low number across the board. So job market looks really strong. Economy still even a little bit lower expected. That's still a good number, 2.8%. And inflation ticking up a little bit. So this is all kind of data we don't want the Fed to take a look, to look at, because they're looking at this and saying, hey, we don't want inflation to get out of control and the job market's doing great. We don't have to cut rates. Next thing, and this one I wanted to take, talk to you guys about a little bit more closely. September pending home sales. This jumped. It was supposed to go up 1% or so. Went up 7.4%. So a big jump. As you can see across the board, Midwest, Northeast, the South all went up. The West led the gains with 9.8% gain month over month. This is all great stuff. And, the other home sales weren't as good, but, again, September pending home sales. So these are homes that went pending in the month of September. This is when rates dropped. Rates were in the low sixes. So, to me, this is a positive sign. Like we've talked about, rates coming down. There's so much pent up demand right now. There's a lot of people sitting on the sidelines waiting for rates to come down. And as you can see, when rates did come down just even to the low sixes, pending contracts popped across the board. People started signing contracts, getting in contract on homes. This is great to see because, like I said, it does back up the narrative that once we do have some rates come down, we will unlock a bunch of pent-up demand in the real estate industry. So something good for industry folk to take an eye on. And then also for people looking to buy, this shows that when rates do come down, demand's going to tick up quite a bit. When demand picks up, prices tend to go up. So it's great to get a lower rate, but there's a lot of reasons, and we can talk more about that offline about why maybe now is a better time to buy than others. The main reason being not as much competition and a lot of inventory out there. So, this was good to see. Pending home sales jumped in the month of September quite a bit, 7.4%. Average 30-year, though, this was not good to see. It jumped this week from 6.91 up to 7.08 as of today. And this is for good borrowers, great credits. Again, this is a lender survey. This isn't one lender or other. This is a means or median lender survey they put out with every week from Mortgage News Daily. So 7.08%. That's not good to see. So really, our hope in the short term is this BLS jobs report tomorrow. That ADP one was not a good sign for this BLS jobs report. The BLS jobs report at the beginning of this month, the beginning of October, is the one that started us in this tailspin. It's been the thorn in our side for a couple of years now. Really dicey data. It's hard to trust it, but it is what they're looking at. This is where we're getting unemployment data from, unemployment rate from. So that will be out tomorrow. We shall see what happens. And then next week, we get the Fed, a couple days after the election, we get the Fed's rate hike announcement. We know that at this point, I think it's 95% chance they're going to do a 25% cut or a quarter of a point cut and a 5% chance of no cut. So pretty good chance we're going to get that quarter point cut. That half point cut odds have disappeared completely. That BLS jobs report, I don't know if it would change anything tomorrow, but I guess if it came in super, super strong, then maybe the Fed would consider not cutting at all a week from now, which would not be good for mortgage rates. So let's keep our fingers crossed that doesn't happen. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.